CCL Products India is brewing up a massive transformation this quarter. If you're looking for smart investing insights, you need to see how they are balancing robust growth with a major domestic pivot. Is the brew getting stronger? Let's dive into the Q3 FY26 analysis. Starting with the big picture, the company reported a massive revenue of 1,051 crore rupees, up over 38% year-over-year thanks to strong volume-led export growth. Net profit, or PAT, hit 100 crore rupees, a 59% jump from last year as operating leverage kicks in. While coffee prices have been volatile, the EBITDA margin remained resilient at 17.6%, and gross debt fell to 1,448 crore through significant deleveraging. Looking at the P&L waterfall, we can see exactly how that revenue converts to profit. Earnings per share rose over 59% to 7.53 rupees, aided by a favorable tax rate of 14% compared to 12% last year. The reason profit is outpacing revenue growth is simple. As those new freeze-dried capacities ramp up, fixed costs are spread over more units, boosting the bottom line. In this margin mastery chart, it is clear that while green coffee prices swing wildly, CCL's EBITDA margin stays remarkably stable. This is their primary defense mechanism, a cost-plus business model that protects their processing fees regardless of raw material price swings. Additionally, inventory days are finally normalizing following a peak back in FY25. The core engine of this business is global B2B exports, which account for a massive 90% of total revenue. Major global roasters are currently de-risking their supply chains and shifting toward multi-geography players. CCL's dual presence in different regions creates a competitive moat that continues to drive volume-led top-line growth. But the rising star is the domestic B2C business, specifically brands like Continental Coffee and Freeze-Dried Extra. This segment generated roughly 120 crore rupees this quarter, growing at 40 to 50% year-over-year. CCL is now the number 2 player in the Andhra Pradesh and Telangana region, and as this B2C share grows, the stock's valuation could re-rate upwards. Now let's talk about the growth runway. Their legacy plants are already 100% utilized, meaning they are running at full steam. However, the new freeze-dried plants are only at 20% capacity. The strategy here is sweating the assets, increasing utilization to 85 or 90% over the next 2 years without needing major new capital expenditure. The company is also undergoing aggressive deleveraging. Debt has already dropped from 1,580 crore in September to 1,448 crore currently, with a target of 1,250 crore by March 2026. With a healthy debt-to-equity ratio of 0.74x and improving interest coverage, working capital has normalized, releasing the cash needed to pay down that debt. Is the price right? The trailing PE is 35.2x, but the EV to EBITDA of 20.9x is actually trading below its 3-year average of 20.9x. With a return on capital employed at 13.1% and an interim dividend of 2.75 rupees per share, the verdict is that the company is fairly valued given its double-digit volume growth guidance. Of course, every investment has risks. You should keep an eye on Vietnam crop issues, which could impact green coffee availability and working capital. There is also a 1.5 crore provision for labor code changes, a new 22 million Swiss franc corporate guarantee for their Swiss subsidiary, and intense competition in the domestic FMCG market. To summarize the bull case, capacity is ramping up from 20% to 90%, debt is falling, and B2C growth offers major re-rating potential. On the flip side, the bear case involves sustained high coffee prices squeezing capital and seasonal dips that might spook short-term traders. Management remains constructive and committed to double-digit growth. This analysis is based on CCL Products Q3 FY26 data, but markets change quickly. Make sure to follow and subscribe ZinvestZ for more visual earnings breakdowns to stay updated on your investments. Thank you.